Good afternoon or good evening, Gabriel Garza and Virginia Hernandez. Let's give them a hand. All right, let's get started with our podcast for today. Take it away.
All right. Well, we welcome all our listeners today. Today, we wanted to really get into what it takes to purchase a home in today's market. So, of course, I have the expert, Mr. Gabriel Garza.
Assisting many first-time home buyers, buyers in general. I mean, I specialize in home financing and definitely have dabbled in all sorts of programs and products. But for some reason, my specialty has always been first-time home buyers and mainly assisting them with down payment assistance programs. I was trained and learned very early in my career that there's four really critical steps to buying a home, right? How much money you make, how much debt you have, how much you can afford. But the key ingredient, and I nail right on the head, is credit. I mean, you have to start there.
Because credit, right? Credit is super important when you purchase a home. So tell us, how critical is credit when you go to qualify a buyer?
Sweet spot is anywhere between 680 to 720. Ideally, that's where your terms get better. You're higher than 720, obviously that much better. Pricing gets that much better for you. If you're below 680, then you need to start looking at possibly maybe an FHA loan.
How low can you qualify a buyer?
Well, FHA will allow you to go as low as 500 if you're willing to put 10% down. 580 to come in with the minimum down of 3.5. So, but it's kind of hard to find a lender that will go that low. So you don't want to do this at the last minute. You don't want to wait until, oh my God, I'm ready to buy now. I want to buy now. And then you come in and your credit score isn't quite where it needs to be. So, start early, start the process early.
Give maybe 2 points of how they can prepare their credit before they actually meet with the lender.
Important piece, of course, is how you're paid, right? If you're paying on time, if you've paid late, if you've got bills that you've ignored, they've gone into collection, they've charged them off, obviously that's going to have a major impact. Sometimes people quite don't understand this part or somehow ignore or don't pay too much attention to it. And that's the correlation between what your credit limit is, in other words, what your maximum allowed, and what you currently owe. And if you're maxed out on your credit cards, it's going to have an impact on your credit score. To start the process, I would look at what you owe and start paying down what you can. If you're not ready to buy today, but you are planning to do this in the long run, then start there. Start by taking an account of what you owe, what your credit limit is, and start paying down. The key is to try to get to 50% or less of whatever your credit limit is. So if your credit limit is 1,000, try to keep your balance under 500. And if you do that consistently, that and paying on time, that has a major impact on your credit, a positive impact, I should say.
Very good points. Next subject would be debt to income ratio. So explain how important that is.
Well, debt to income ratio, when you're qualifying for a loan, lenders take two what we call debt ratios into account. The first one is your housing expense. In correlation to your gross income. When you're qualifying for a loan, in most cases we qualify you based on whatever your gross income is. And so again, whatever the housing payment is going to be, normally it's whatever principal and interest, which is the mortgage payment, the taxes on the property, your home insurance, if you're buying a condominium, the homeowners association fee, if you're putting less than 20% down, mortgage insurance. When you take all that into account, that becomes your monthly payment. That divided by your gross monthly income has to equate to a number, a ratio. And that ratio, usually lenders like to see anywhere from, on the better end, 30-35%. On the higher end, anywhere from 42 to 45%. That's kind of sort of stretching it. So that's the first ratio. The second ratio is taking your total monthly obligations, car payments, credit cards, student loans, credit unions, installment loans, taking all those loans into consideration and adding those payments into that monthly mortgage payment, and then again, dividing it by your gross income and then coming up with a number. And again, the ideal situation is 40 to 45 on the bottom end. We call it the bottom ratio, and or anywhere from, if you're dealing with an FHA loan, you can go as high as 57% as long as you're able to get an automated approval.
So our third subject would be employment and work history. How much does that play a part in the qualification?
Rule of thumb is 2 years of employment, continuous employment. So does that mean you have to be at the same job for 2 years? Ideally, that would be a good, strong, compensating factor, right? But it doesn't necessarily mean that you have to be at the same job for 2 years. If you've been in the same line of work and you've changed jobs because of a better opportunity, as long as there's not a major gap between your previous job and your current job. A major gap is usually considered anything more than 3-4 months. If you go into a period that is longer than 6 months, now you start running into problems. FHA normally, as a rule of thumb, would like you, if you've had a major gap in the past, they like to see at least that you've been back to your new job, whether it's with the same company, if you took some sort of extended leave, but it's either with the same company or with a new company, that you're back at least 6 months to the new job and able to show a history prior to the leave of at least 2 years or longer.
Fourth subject would be down payment and savings.
Again, depending on how much money you're going to come in, for some reason everyone thinks, and they make that assumption that you need 20% down. You got to come up with 20% down. I don't have 20%, so I can't buy a home. And in reality, there's programs that allow you to get in with as little as 3%, 3.5% if it's an FHA, 5%, 10%. And again, it's your down payment plus your closing cost. And again, the closing cost is what we're going to collect from you as the mortgage company, our fees, our costs. But in addition, all the other fees that take place, such as your escrow and title and all the other fees that go with it, the appraisal, the credit report, and then of course your impound account, or the collection for your prepays, which is your taxes and insurance that are going to be ongoing, but we collect some of that upfront as a deposit. So you take that total plus your down payment, and that equates to the total amount of money that you're going to need. In some cases, reserves are helpful. If you're dealing with a marginal loan, if your debt to income ratios are high, if your credit's not that strong, then something that helps you along the way is to have some cash reserves, usually anywhere from 2 to 3 months. Some of that could be a gift. Some of that money can also come from a seller credit. I know in today's market that's a little bit difficult, but a seller credit, coming up with some sort of assistance. And then of course, as we talked on our last podcast, the down payment assistance programs are designed to help you sort of assist with coming up with some of that shortage that you may not be able to come up with on your own. Or again, you can resort to some sort of gift, whether it's from a family member. I know a lot of times people don't take this into consideration, but you can actually get a gift as well from your employer. So if you have a generous boss, you've been with them for quite some time, and they're willing to help you buy your home because maybe, they want you to stay within distance to your job. They don't want you moving out to another city or another state because, you can't afford to buy a home here, or you don't have the money to buy it. Maybe your employer is a resource that can help you, come up with part or some or all of your down payment. That's an allowable source for down payments.
Let's talk about common mistakes or missteps that some potential buyers do prior to qualifying for a home loan.
Well, I think the first step is not getting pre-qualified, not sitting down with a lending expert that can sort of do the analysis up front. Start planning ahead. A good critical piece to this whole process is budgeting, and a lot of people, don't take that into consideration. Start by looking at your bank statements. Take a good look at your last 2 or 3 month bank statements and see what sort of spending. A lot of times, it's a sacrifice that you have to make when you make a commitment to buy a home, but it doesn't have to be that extreme if you plan accordingly. If you start budgeting yourself, if you start liquidating and getting rid of some debt. There's 3 things that are consistent when you buy a home, right? Value of the house is going to go up. hopefully along the way, whatever interest rate you get today may improve and you might be able to refinance and lower your monthly payment. And for sure, your income will go up. And that will create additional wealth by, reducing your monthly payment, by paying down on some debt, and then eventually getting accustomed to whatever your housing expense is, and then hopefully taking that difference and reinvesting it in whatever is going to create, generational wealth for you. So, our mission is not only to help you get into your home, but we want you also to keep your home. We want you to be able to afford it, be comfortable, and obviously with some sacrifice. I'm not going to sit here and paint a pretty picture that it's super easy. There's some sacrifices that are along the way, but the key is that you're building wealth and you're owning your own home. And the main thing is that you're planning to do this correctly and for the long run. And, again, for your family.
Of course, the lender is our first step. I come in to play as the realtor once you get your qualification. And the one thing that I always teach my buyers, especially first-time buyers, is you always want to buy what you can afford. It's so important to stick to a budget. And your first home will always be what you can afford. By your second or third home, you're getting closer to your dream home. Second is always taking into consideration resale. You want to always understand what you're purchasing and kind of imagine in 5 years, is that property going to give you some good equity? Like to close up by thanking Gabe again.
Welcome.
He's over how many years of lending experience?
Over 44.
His expertise, you can only imagine how many deals he's put together in those 44 years. The experience is part of this team here.
Thank you.
21 years in the real estate business and just love helping out. And I am Virginia Hernandez, Century 21 All-Stars, alongside
Gabriel Garza, American Financial Network, here in this beautiful city of Montebello.